Hello. Yes, good afternoon, everybody. I hope you can hear my voice and also see my screen. So today's session, we're going to look at a simple strategy on how to trade indices, how to trade major news events. So you remember we've looked at this before, but we looked at just one side of it where we're looking at just two concepts about news. Today we'll add the two others. So what I want to say here is that there are several news that relates to several things. There's not just one news that deals with one thing, no. There's several news that affects several things. So before you trade, the main news that's always done once in a month is the non-farm payroll news. So it's called NFP. The other name is NFP. What happens is this: every month there's a news release stating how many people are employed and how many people have lost their jobs in the United States. So this news is very, very significant. It happens the first Friday of every month. So let's write that. It's known as NFP. It happens first Friday of every month. Sorry, this is not the correct spelling, so it should be first Friday of every month. So what happens here is, in this news, they normally release the news that shows how many people were employed in the United States and how many people lost their jobs in the United States. So if many people were employed during the past week, that is good news for some currencies. And if many people lost their job, that's bad news for some currencies and also some indices. So I'm not saying that if the people are employed, then it's only good for indices. No, it is good also for some companies, and it's also good for some indices. So it's good for all round. It is good for everything. So how does the NFP itself affect the charts that we are seeing here? So one thing you need to know, that we do have several economies. All these economies are united by one thing in common. They are united by the United States dollar. So if many people are employed, the value of the United States dollar is going to improve. It's going to be slightly expensive compared to when everyone else is losing it, doesn't have it. So when many people are employed, the United States dollar tends to increase in value. And when many people loses their job, then the United States dollar also tends to lose its value slightly. So when it has lost its value, it means the purchasing power of people increases. So many people are able to import things from the United States, to travel there, to do a lot of stuff. And something which is very, very weird is that you may hear the news that many people are employed, but at some time, the chart of that US dollar is doing something exactly opposite. So be prepared for something like that, where you hear a different news, you hear some news which you expect it to affect a given currency pair, but instead it does exactly something opposite it's supposed to be doing. So be prepared for events like that. Be always aware that such a thing is possible. A case where you have a currency, you expect it to affect a given thing in a given way, yet it does exactly opposite that one. That is possible. It may happen. Does that make sense? So the other news is the other category of news which normally affect how the charts move is this one: interest rates. Interest rates. Let me write that down. Interest rates. So this is basically the cost of borrowing or the cost of lending money. If a company is about to go bankrupt, then they decide to borrow money from a financial institution, then the amount of money they charge from that institution becomes the interest rates. So the amount of money which they are going to pay in excess of the amount which they borrowed is known as the interest rate. So if they borrow maybe 100, and then the borrowing firm tells them, the financial institution tells us, okay, you'll pay us additional 5% every month. So that 5% is the interest rate. How does that interest rate affects the way the chart moves? Okay, what happens is this. Any interest rate affects just the company involved in it. So if they say, if you hear that the interest rates have increased maybe from what? From 5 to 10%. This is double, an increase of double. Assuming you hear something like this, that the interest rates are increasing from 5 to 10%. So what this basically means is that the cost of borrowing has increased. The cost of borrowing has become borrowing has become very, very expensive. So this means that there are companies that strictly rely on borrowing for growth. Those companies will not be able to grow. They'll have to hold their progress until after their earnings are able to enable them to grow. So that means if, for example, if you hear something like this, just rush over here, do some research, look for companies that normally depends on debt to develop, and look at their progress. See in the past, check if those companies were giving some indication that they need loan, or they are applying for bankruptcy, or you suspect that they may be needing a loan. Then this happens, just know that that company, the value of their shares is still going to depreciate. So you're supposed to still look for sell positions on such cases. So in such a case, the interest rates becomes very useful to those companies here that are depending on interest rates to grow. That means there will be no growth. There may be some growth because of some internal operations, maybe buying, selling, some earnings, but the interest rate affects them mostly if they rely mostly on their loans to grow. Does that make sense? So that's what happens if the company, if a company depends on loan, then news comes up that affects that given that affects the rate of borrowing, then that will affect that company's in a manner that is really visible. So the other thing is a case where the interest rate increases, a case where the interest rate decreases. So we assume that the interest rate was this one. So this, I'll make this green. We assume that it was 10, then it has gone to 5%, 5 or 6%. So this is red, this is bad news. If anytime the interest rates increases, that is bad news for the borrower, and anytime the interest rate increases, that is good news for the person borrowing, because it means they'll be paying less in excess of what they borrowed. So when you see something like this, when you see a case where the interest rates have decreased, have increased, I've said that already. If they decrease like this, come here quickly on this market watch, then look for, maybe check Amazon, go online, check the research, check the company news, what has been happening so far. See, look for any indications that they wanted to borrow money, or that they were selling their shares, just things that are showing that they're trying to raise money. You know that if they try to do that, and normally they depend on the borrowing, then they're likely to borrow at this rate, maybe at 6. So 6 means they are able to borrow a lot of money compared to if the interest rate was 10. So they borrow there, they are going to expand themselves, they're going to hire more people, and the value of the company is likely going to increase. So that is what causes the shares of some companies here to increase. You have to check first of all and ensure that those company which you're trading news on, they are in a way directly affected by that news. Otherwise, that news will not affect every other thing. So don't assume that now that the news affects the dollar, it will affect everything instantly. No, it may affect the dollar that very instant, but the effect will only be visible maybe after a month or two. So you don't want to find yourself trading something which should be affected in a month or two. You're already executing it now. You're going to be too early for that. So these are the two main things which I normally look for whenever I'm trading news. I first of all check NFP, that's the first Friday of every month. And then the next thing I check is interest rate in the light which I've mentioned, increase or decrease in the interest rates. Then the next thing is I check those instruments or those company shares, companies that strictly rely on loan to expand themselves or to increase their inventory. So if there's an increase in interest rates, then that means that they're not going to borrow anything. They're going to find it hard. If there is a decrease in interest rates, then that means their appetite for loans is increasing tremendously. So thank you very much. That should bring me to an end of today's webinar. I will meet again next week at the same time. Thank you and see you.